Hello everybody, coming at you once again with another PTT Elite Methodology in Action series videocast. This is a part of the PTT Elite program, our $15,000 a year program, but we are offering this aspect of the program to you, our first year customers, for free, our gift to you for helping us get off the ground. Let's jump right in. So GLUU Mobile today is under pressure once again. Might be looking at some overflow from yesterday's negative article from the Street Sweeper. There's been additional negative flack thrown at the stock by thestreet.com, and it should be known that those two entities are very closely related. Okay, so something's up with those two. I'm familiar with some of the dealings of some of the folks that are involved there, and without casting any allegations that might get me into legal difficulty, let's just say that they have some vested interests and can be very motivated when those vested interests are out there. So we do have a breach of the short-term risk-reward lines, that technical line. It may be creating some panic out there in the market. I don't know if this will serve as a support level to hold. Who knows, right? This is why investing is all about the fundamentals, the value of the company. And I continue to believe that this company has a higher value than what the stock price reflects. And therefore, even with this breach, I am unfettered in my resolve with regard to the company and how it probably did this quarter, which is the next major data point we will get. In that regard, Northland Securities came out this morning in response to the ridiculousness of yesterday's situation, raised the stock to a buy rating and iterated that they believe that a beat and a possible raise is in the cards for the stock when they report soon. The stock actually opened up and rose about 4% pretty quickly, and then we had the Street.com article come out, and so I don't know, what causes what movement in any given day. At the end of the day, the stock market is down. You got some negativity out there. I try not to diagnose any one day's events because at the end of the day, a stock is down because there are more sellers than buyers on that particular day. We certainly have a much lower volume than yesterday, and that's really all I can say about that. I know what I feel like the company is worth, and whatever people want to pay for it is up to them. I'm quite happy with my ownership position, and my only regret at this stage of the game is that when we hit the risk-reward bottom, one thing that is often a good idea to do is to wait until the trend is your friend again, right? Because even when we hit a risk-reward bottom, the trend is still down, and indeed, it's down again today. So I should have waited for that before boosting myself back up to a 10% position. I didn't, but that's okay. I'll live with it. I don't need to catch every penny on this thing. And like I said, I feel really good about the earnings they should be announcing in a few weeks. So, interestingly enough, I may be one of the only people that feel good about the earnings coming up because the short interest has reached the highest level I have ever seen. So, it'd be interesting to, in the final analysis, once the earnings are out and we see where the stock ends up based on that, what happens to this short interest, and maybe we see what everybody's motivations may have been in hindsight. And of course, hindsight is always 20/20. It won't do us any good today. All right, so on to other things. We had a post in our members forum, and here's the URL. If you haven't visited the members forum, it is a very valuable piece of your membership. So please go there and take advantage of all of the subscribers that are there having very rational, adult, mature discussions about the methodology and our picks. It's a much better place to be than the Seeking Alpha boards, and infinitely better place to be than the Yahoo chat boards, where most of the people there are simply self-serving, talking their own position, and trying to push people's emotions around. And as you know, emotions are the enemy of the investor, which is why we have the methodology, an emotionless entity. And of course, this emotionless entity takes precedence because I am only human. And so in the methodology, there's a rule very much stated there that says, my apologies for that, that says you should view the rules of the methodology as taking precedence over anything I do or say publicly. The reason for that is that I am prone to human emotion like anybody else. I do not follow the rules of the methodology to the letter all the time because I get scared and excited as well as anybody else can. So the extent to which you can follow the methodology to the T, you will have greater success than I have had with the methodology. And that success is something I'm very proud of. But I know I leave a lot on the table by breaking some of these rules sometimes. So, getting back to the post that was put up in the forum, one of our readers made a comment with regard to the poised to rise 50% article that I put on Seeking Alpha regarding GLUU Mobile, okay, and asked why I should get a free pass on that. My response is, of course I don't deserve a free pass, okay. It's likely that that call will be proven wrong, and frankly, it was a mistake to put that article out there in the first place, right or wrong, because as I've said before, I'm not a trader, I'm an investor, and I am well aware that stock prices will move in any direction they want, and that the most important thing is to understand the fundamental value of a company, because that is ultimately where a stock price should go over time. But none of us can predict where it will go at any point in time. So, as a result of that knowledge, I should have known better than to get caught up in the hype that was going on with Kim Kardashian and put out an article of this type. So, I apologize. I accept any kind of flack that I deserve from that. It is definitely deserved. Now, how do you avoid getting caught up in when I make a mistake like that? Okay, there's something I will tell you. I consider myself to be a God-blessed analyst. I am well known by many Wall Street analysts, and I'm well respected for that skill. I don't have many, but this is one of them. But I am definitely a flawed investor, and there's a big difference between the two. Being able to sit down at night and objectively calculate the value of a company is very different than having the psychological wherewithal to invest in that company effectively. Okay? There are many folks out there, both amongst our subscribers, many of them talk about this, and my customers in the Wall Street world that make more money on my picks than I do, because while my picks in aggregate have done great over time, my execution on those picks as an investor has been very flawed. So this is where you can actually beat me out. This is where you can generate greater than 40% annual returns on average. And it's by beating me when it comes to executing on the methodology. So be sure to go read the methodology, learn it. I read it often. You should read it often. The better we get at executing against those rules, the safer you'll be in down markets like we are in right now, and the more money you'll make in up markets. like we will be at some point in the not too distant future, hopefully. Okay. So, looking at the article that I put out, this is no excuse, but the reason I put out the article, it was predicated on my seemingly absurd prediction that GLUU would double their revenue guidance for Q3. At the time, their Q3 estimates were about 37 million. And indeed, on the call, they doubled those estimates, and then some. My mistake was assuming that the stock would go up on that news, right? Of course, the methodology told us that the stock was near its short-term risk-reward highs, not to get caught up in the euphoria, and that risk-reward high was telling us that everybody was euphoric about the stock, including yours truly. And as a result, despite that news being, I don't think I've ever seen a company double their revenue guidance in this industry before in 20 years. Despite that, the stock went down. The methodology won out. So keep that in mind. Okay, and again, none of those things provides any justification for a free pass for yours truly. I made a mistake in putting out an article regarding trading, but hopefully you already had your 10% position at that time, were adhering to the rules of the methodology, and hopefully sold your position at 750 at the top of the risk-reward chart. I have been communicated with several of our subscribers who let me know that that's exactly what they did, and I applaud them for that. I personally did not, and it cost me 6 figures in profits. Personally, doesn't change the value of the pick or how I feel about the pick. I check and double check all of my work meticulously on these things. I'm telling you right now, I will resign if these guys do not beat the revenue guidance for Q3. That's how confident I am in my work. Okay? So, there's some other things in the methodology that are important to understand, and this is our third and final lesson of the day. If I decide that I've made a mistake and give up, it's time to sell. This cannot be overstated. The success of my portfolio in the portfolio tracker, if you look at the wins and losses in here over time, we've had stocks that go down and then go up, stocks that go up and then go down. They go all over the place before the final analysis, before the final ROI is tallied. And there's only two things you really need to know if you're a buy and hold investor. If you don't want to use the risk reward charts to try to make extra money, if you're a buy and hold investor, you only need to know two things. No matter what the stock does, you hold it. And many of these stocks started down and ended up 200%. Okay? That's one thing you need to know. The other thing you need to know is not all of my picks are going to work. And a lot of my picks that do work may not work later. And that's because of two things. One, I focus on handicapping stocks. In the case of Global Star, when the stock was 67 cents, I thought that it had potential to go to $4. I also thought it had potential to go to 0. And I thought that the odds of each were roughly 50-50. If you look at a 50-50 bet, where heads you get 0, tails you get $4, the value of that bet is $2. So I felt that the stock should be at $2 to accurately reflect the upside potential to 4 and the downside potential to 0. And what happened? Well, of course, the stock took off from our initiation price to 2 and actually kept going and got to $4. It reached its full potential, right? But we were gone at this point. Why? Because when the downside is 0 and the upside is 4 and the stock's at 2 on a 50-50 bet, you don't want to take that bet. If you want to take that bet, go to the casino and bet on red, right? Because it's a 50-50 bet at that point. Down here, it was a great bet. And my hope was to ride the stock up until that bet was no longer attractive, a 50-50 bet. And sure enough, that happened to be here. Stock continued to go up. You saw the negative report that came out this week, and still the stock is over our graduation price of 201, despite the major negative reports that are the allegations being cast by that firm. Okay, I have no comment on this. I have no further information. Global Star has done a great deal of research to counter the claims. The claim provider, I forget the name of the firm, Carisdale, I believe, did a great deal of work into the stock. And my initial assessment remains intact, which is the stock is either worth $4 or 0, and therefore at this point it's worth $2. And sure enough, it's at $2. Nothing to see here. All right, there's no advantage to be had here, and that's why you hold the stock until it reaches fruition, or until I give up on it. And what will end up happening over time is you're going to have a set of winners that go up a lot, and a small set of losers that we are going to give up on before they can hurt us badly. You see these losses, 20, 28%. -7 we gave up early, that one, and that paid off. Excuse me. Rainmaker, -20. If your winners, if you let your winners run and make 100, 200%, and you win most of the time, it's going to make it impossible for you to lose if less than 50% of your stocks are not allowed to hurt you badly. And this is what we've done. And this is why when these picks graduated by tripling or being sold off because yours truly decides that there's been a flaw in the thesis. In the case of DLIA, I had to admit 2 things. 1, last winter was horrendous and it really killed retailers. 2, Alibaba's coming to town and it has only caused the e-commerce players to accelerate their initiatives, which is only making things worse for bricks and mortar retailers. And 3, I was clearly too early in putting trust in Tracy Gardner's ability to fight through those first 2 roadblocks. And so, with a 28% loss in hand, I waved the white flag, and that was the time to sell. Okay, and you don't want to wait, and we'll show you why. Here's a few examples. So, Tech Precision. This is a stock that has been moving all over the place over the last several years. Here's a chart. Okay, we got involved down here at 40 cents. That's when we said poised to triple. The stock had a multi-month move up to $1.20, and it tripled. Since that time, the company has been subject to delays in many of its projects at a time in which it is in financial distress. Okay? That's problematic for any company. If you are in financial distress while your projects are being delayed, you are at risk of bankruptcy. I'll say that again. You are at risk of bankruptcy. So, if not for the fact that the stock tripled and told us to get out, at 120, not its high of I think 140 or so, but 120, right? If we hadn't gotten out at those levels, I would have personally gotten us out at whatever lower level as I saw the signposts on the wall that there's financial distress and further delays in their deals. How's this going to turn out? It's hard to say. Mevion has filed for an IPO. I view that as bullish. I view that as bullish for Tech Precision, but that is offset by a lack of knowledge in terms of how their financial situation is going to play out in the near term. Personally, I think the dust needs to settle where we see Tech Precision starting to pull a profit from its Mevion and other relationships before we can start to feel comfortable that they're not going to need any more financing, because any further need of financing could send the stock to zero. So hopefully you got out when it was $1.20. Hopefully if you didn't, it was only a 1% position, so it doesn't give you too much pain. But at this point in time, given the choice of owning the stock or not owning the stock, my preference is to not own the stock unequivocally. Otherwise, it would still be in the portfolio. 2, GSAT. We already talked about this one. Same thing goes for that. Okay, I had a lot of folks tell me, hey man, you messed up. You sold at $2 and it went to $4.50. Fine. I have no problem with that. Things work both ways. I have plenty of stocks in the portfolio that continued to go further up after we picked it. All right. We have Lions Bridge is a perfect example. We got out at $3.69, and I think that stock went to $7 at some point. It's okay. It's going to happen. If these companies stay in business, $7.46 was its high. It's still above our triple level, right? That's okay. We're not here to make every penny. We're here to get the low-hanging fruit, to buy the stock when it's absurdly cheap and sell it at some point before it even reaches fair value, because fair value implies a 50-50 bet of going up or down from that point relative to the market. And we don't want to do anything relative to the market. We want to outperform the market. DLIA is another piece of information I'll give you on DLIA here was we provided this alert back in May about profitable insurance. And, prior to this, when I waved the white flag on DLIA and started talking about the troubles that the bricks and mortar retailers were having, one thing I was talking about was hedges. And you hear a lot about hedges of late from me, to buy the US dollar, to short China, the FXI, to short the Russell, the IWM. But also, if you can find good shorts in the industry in which your company competes, like for GLUU Mobile, I am short King, and that's worked out nicely. And for DLIA, when I was long DLIA, being short names like Cache, GNC, and Wet Seal paid off very well, because any of the money that you lost in DLIA was made up by the money you made by being short some of these names. And that saves you, because at this point in time, as you see on this chart, DLIA was holding its own while some of the short ideas that we were providing to our PTT Elite customers were getting absolutely hammered. And so at the time we got out of DLIA, which was about 2 pennies below where it was on this chart, 81 cents, right? We were still only modestly hurt, down 27%, whereas Wet Seal had been down some 70-something percent. GNC was down by a third, and Cache had completely fallen out of bed and was down about 80%. This is how you win. This is how you win even when you lose, right? By keeping the number of losses to a minimum, which we do, keeping the amount of your loss to a minimum, which we attempt to do by informing you when we give up on a pick, when we realize this is probably one of our losers. Let's get out of this situation. And by engaging in profitable insurance, by putting on short hedges in inferior names. Profitable insurance. Okay, and this is what you avoid. This is another stock, by the way. You'll see the theme here, obviously. I showed you the chart of Tech Precision, told you the possibility is there for it to go bankrupt. Showed you the global star. Oh, we got rid of the chart. We'll bring it back up. And mentioned that I believe the upside is $4 and that the downside is 0. And indeed, Kerrisdale believes that 0 is the answer. I can't tell you what the answer is going to be in the end, because the answer is it's either going to be $4 or 0. That's the answer. And you play the stock on that basis, depending on what the odds of each outcome are at any given point in time. All right? That's how it's done. You can't always make a call in a situation because you can't accurately predict the future in certain situations. And that's why these stocks are speculative in our portfolio tracker. Okay? And here you see Tech Precision, Global Star, DLIA, we're all speculative 1% positions because of the extreme risk involved against that high potential upside. And that upside sometimes pays off. Pixelworks, Tech Precision, and Global Star all gave us the opportunity to triple our money and move on versus some of these losses that take place here. Okay? So that's it for today. And hopefully you've gotten something out of this. So let me leave it with my normal exit statement, which is, through ups and downs, through thick and thin, PTT Research is here to teach you the lessons that made Peter Lynch famous and Warren Buffett a billionaire. Stick with us and we will stick with you to teach you more lessons on how to become a millionaire, keep your millions, make more millions, and who knows, maybe someday you too will be a billionaire like Buffett. Until next time, this is Mark Gomes wishing you great prosperity, telling you to hang in there during this market decline, keep your hedges in place, keep the stocks that you love, and I'll talk to you soon. Take care.